Hey, welcome to Strategic Trader Session 3. We are about to get rolling on our measurement of market activity. You know, we've already talked about perception reality. We've talked about what is a market and how they work. But we want to answer the question that there really is, how's the market doing today, right? That's what you hear people say. What did the market do today? How'd the market do today? And in Session 3, what we really do is we dive into the ability to answer that question, right? What did the market do today? So we're going to start with how we measure a market. And how we measure a market is not going to be on the totality of the market in most cases. In most cases, when you ask somebody about measuring the market, what they're talking about is the index, right? They're talking about the market index. Now, what is an index? An index is a statistical measure of the changes in a portfolio of stocks representing a portion of the overall market. Now, here's the key. It's the portfolio of stocks, meaning it's a basket of stocks, right? It's a basket of stocks, and it represents a portion of the overall market. It doesn't represent every single stock that's in the US or the global markets. It's a portion of those stocks. And so what really matters is who decides what goes in the index, right? And the purpose is to measure the activity on an exchange or on a market in general. So when we're looking at indexes or indices, we're going to have to know which indexes are we looking at. Well, here's what's interesting is that the index that you look at is going to be different based upon where you're looking. You know, there's indices all over the world. In Asia, you might look at the Nikkei, right? The Nikkei index is a very, very common index to measure market activity in Asia. You might look at the Hang Seng or the Nifty. Those are all markets that are very important in the Asian economy, right? One being Japan, the Nikkei being the Japanese markets is probably the one that's quoted most often. But you will hear about the Hang Seng, and then the Nifty in the Indian markets as well is a very common thing. Now, the Asian markets, if you think about our 24-hour day, the Asian markets are the first ones to open, right? The Asians would be the first markets to open, and they are typically going to be a leading indication of what happens in the European markets. And in the European markets, you have the FTSE in the UK. You've got the CAC and you have the DAX. And the DAX is the German markets. So typically when you're hearing about Europe, you're hearing about the FTSE or the DAX. Those are really the two that matter the most. And the DAX is probably the one that is most telling to what the US markets are going to do. So the German DAX is probably the most telling. Now, these 6 that we've talked about so far, that's not the only 6 indices. Right? There are indexes for the Australian markets, for the Indonesian markets, for there are indices for the Abu Dhabi markets. There's indices all over the world. But these are the big ones that most people are paying attention to when they talk about global market movement. Then we move into North America. And in North America, these are really the most commonly traded markets, the most commonly referenced. And you have the S&P 500, the Dow Jones, the Russell 2000, the NASDAQ Composite and NASDAQ 100, and then the TSX Composite, which is the Toronto Stock Exchange. So when I'm looking at the North American markets, you're primarily focused on the US and Canada. Now, the US markets are the ones that are the most widely traded in the world when it comes to equity markets, and they've got the most recognizable movements. And all over the world, people will look at those markets. But we've got to think about our 4 majors. And the 4 majors that we look at in North America are the S&P, the NASDAQ, the Dow, and the Russell. So the S&P, the NASDAQ, the Dow, and the Russell. And when I think about these 4 markets, a great way to think about them is how do they move, right? How fast do they move? How quickly can they turn? How quickly can they change directions? When I think about our markets, the market that I think about most commonly is the S&P 500. That's the one that is it's the one that really is, to me, the biggest picture of the U.S. economy. About 85%, give or take, of the U.S. total market capitalization is held in the S&P. And the S&P 500 are 500 large cap stocks, so 500 big companies. And when I think about the S&P 500, what I'm really getting is a clear cross-section of the total economy. So when looking at that cross-section, let's go ahead and take a look at a heat map that represents the entire S&P 500. So this is a picture of a heat map of the S&P 500. Now, this shows me all 500 stocks that are in the S&P 500. And you can see that this S&P 500 is broken down into different sectors. For example, the information technology sector, the communication sector, the consumer discretionary sector. And these white borders tell me what stocks are in which sector. Now, what's interesting about the S&P is that the bigger the square, the more that stock movement impacts the S&P 500 because these squares are based on what's called market cap. So you might say, well, Boeing is a really, really big company and a really important part of the S&P. Well, yeah, Boeing's important. Here it is right there. There's Boeing. But Amazon is 5 or 6 times larger than Boeing, right? If you think about it, maybe more when you look at the size of Boeing and you look at the size of Amazon. Now, these squares are not static. They are dynamic. They change based upon the price of the underlying security. As the underlying security goes up in price, the number of shares remain the same. The market cap of that company grows. And as companies go down in price, you see that the market cap will shrink. So depending on the individual stock will change the size of the market cap. For most of my trading career, the largest stock by market cap was ExxonMobil. Here's ExxonMobil way over here in the corner. And it's a very, very small square relative to some of the other rather large ones that are out there, right? Microsoft, Nvidia, Apple, Google, Facebook, Amazon, Johnson & Johnson, Disney, Visa, MasterCard, and so on and so forth. So when I'm looking at the S&P 500, I got to remember that the S&P 500, this represents large capitalization, big companies. And what we're looking at here is the performance over one day, right? All we see here is a one-day performance of the S&P 500. Now, the S&P is broken down into these different sectors, and we'll talk more about this when we talk about top-down analysis. But for example, if I just wanted to look at the energy sector of the S&P 500, these would be the stocks that are in just the energy sector. If I want to look at the whole S&P, that would be this sector. Now, these are in red. And these are in red because on the day that we're doing this recording, the S&P had about a 2% pullback, a 2% drop. But even though the S&P had a 2% drop, we can see that there were some stocks that were still up, right? Nvidia was up 3.4%. Kroger was up 4.3%. Abbott Labs was up 1%. So you can see that some stocks did have up days, but for the most part, the markets were, pretty red and had a pretty down day. Now, the S&P, in my mind, is the most important of all the indices, but it's typically not the one that most people reference. The market that most people reference is when they reference the markets is they talk about the Dow Jones. Now, the Dow Jones is an index of 30 companies. And you can tell right away when we go from the S&P 500, where we've got 500 companies, to the Dow Jones, where we only have 30, you can see that Apple and Microsoft make up a huge percentage of the Dow Jones in their size. Their market caps are relative in here. But there's only 30 companies, which means it doesn't have the same amount of diversification that, say, the S&P 500 does. Now, these are what we like to call mega cap stocks. And a mega cap stock is going to be a big, gigantic stock in which the underlying securities are going to be slower to move, right? These are much slower to move underlying securities, typically made up of mature companies that pay a dividend and pay a yield. And the Dow Jones has always been really the high yield dividend paying stocks that people, want to invest in. And so it moves slower than the S&P, right? Moves a bit slower than the S&P. Now, what about the NASDAQ 100? So the NASDAQ 100 is made up of, you guessed it, 100 stocks that are listed on the NASDAQ exchange. Remember, the NASDAQ is an exchange, and we talked about an exchange earlier. An exchange is a place where stocks are bought and sold. The NASDAQ 100 is the index. It's the measurement of what happens in that exchange. So one of the key things to remember about the NASDAQ stocks is that the NASDAQ stocks typically have higher beta than the S&P and the Dow. Now, a beta is the movement of the underlying stock relative to the S&P 500. So a stock with a beta of 1.0 would move the same as the S&P, right? What that basically means is if the S&P goes up 2%, you multiply times the beta, which is 1.0, the stock will probably go up 2%. Oftentimes, NASDAQ stocks will have a slightly higher beta because these are oftentimes, being listed on the NASDAQ, they're going to be stocks that are more tech driven, a little bit more growth stocks, whereas the Dow Jones are probably the more mature stocks. The NASDAQ stocks are going to be a little bit more growth. Some of them are heading into the mature phase when we talk about the life cycle of a company. They're heading into the mature phase, but they're still in the growth phase. And so typically moves a little bit faster. And then we have our market that's the fastest mover, which is the Russell 2000. Now look at this diversification, right? This is 2,000 companies, but this is 2,000 small cap companies. And a small cap company means that they're made up of smaller, faster moving, higher beta stocks. Now, oftentimes this will be, well, some people will call this the canary in the coal mine, if you know what that means. They used to send canaries into the coal mine to see if they would survive. And if the canary didn't make it, it was probably bad news. Well, the Russell 2000 being the early indicator, because what happens is sometimes a professional investor may say, you know what, this market's looking weak. I don't want to put my money into these speculative, low, smaller companies, these small cap companies. I much rather want to go with something that's going to pay me a yield or a high dividend. And so the Russell will move significantly faster than those other four markets. Notice the amount of companies that you have, and they're all fairly small, right? One is not necessarily that much bigger than the other, but they are typically under, they're typically under 10 billion in market cap as far as the size of the company, and so they're definitely smaller companies, faster moving companies than what you'll find in the Dow and the Nasdaq as well as the S&P. So what does that mean for me as a trader, right? What does that mean that I'm looking for in these markets? Well, look at how they all move. Here's the S&P, the Nasdaq, the Dow, and the Russell. When I'm looking at a chart, they all look very similar in shape, right? But think about how fast they move. And the analogy I like to think about is like a ship. Think of the S&P as a battleship, right? It's big, it's hulking, it carries a lot of firepower, right? Carries a tremendous amount of firepower, but it takes some time to really shift and move. Now, the NASDAQ is more like a destroyer. It's going to move faster than the battleship. It doesn't have the same firepower, but certainly still a valuable tool in the arsenal. And then there's the Dow Jones. Well, that's your aircraft carrier. And that aircraft carrier is going to be the one that takes the longest to move. And if you think about it, everything is done to defend the aircraft carrier, right? Because that's the one that, all the other ships defend the aircraft carrier because that's the one that really is the telling of what happens in the battle, if you will, right? So when we look at the Dow Jones is really the one that most people reference. It's the slowest to move, though, because it's made of those mega cap stocks. Then you got the Russell 2000, and that's a speedboat in the water. It's much smaller stocks, much smaller companies with the ability to move in and out very, very quickly. So as an investor, what does that mean for me, right? As an investor, what does that mean? Well, as an investor, we want to be able to understand what these markets are all going to do in order to find my best opportunities. So think about it from an investor standpoint. How do most investors invest in the market, right? What do most investors use? Most investors are not going out there and they're not buying individual stocks, right, in their portfolio. Most of them are utilizing mutual funds. So we grabbed a list of the top held mutual funds in 401k accounts. And this list included stocks like the Vanguard Institutional Index Fund, the Fidelity Contra Fund, the American Funds Euro Pacific Growth, the Fidelity 500 Index Investor, the Vanguard Wellington Investor, Dodge and Cox, Fidelity Growth, Vanguard Prime Cap Investor. So of the top 10 most widely held funds, 8 of them were stock funds, 2 of them were bond funds. We left the bond funds out for this example. But in looking at all of these, this is the ticker symbol of each of those funds. When I'm looking at these particular funds, what's interesting about it is, let's pull them all up on a chart. They all basically look the same. And they all basically look like the S&P. So for those of you that are utilizing the markets to gauge your 401k positions and where you think good opportunities are, when the market goes down, typically the funds will all go down with it, right? You're going to see the funds go down with the market when the market goes down because they typically follow the same general pattern and general shape of the S&P. And so if you learn to read the indices, that can be a true precursor to what the items in your portfolio might do. So hopefully this makes sense to everybody. And as always, if you need some help, feel free to send us an email, support@tradersarmy.com, or send us a text. We are here to help you. Hope you guys have a great time. I'll see you in the next session.